Hello everyone, here Chris Capre, founder of Second Skies. Today we are doing a 3-hour monthly webinar with FX Street. I want to thank FX Street for hosting this there, and thank you all for coming in such good numbers. And so this first part, this is the open webinar here. This first part is about learning to read price action. We're going to talk about how to read price action on a pure basis without indicators or not even looking at the indicators. And then we're going to talk about a couple different methods that I use beyond that there. We're going to talk about the momentum box, starting to incorporate indicators after we get the basics built into them. We're going to talk about how you can use Bollinger Bands, EMAs, particularly 20 EMA, and then we'll talk about some reversals as well. So we got a lot of ground to cover in an hour and a half. However, at the same time, I don't want you to feel discouraged from asking questions. Questions is part of this webinar, and questions really come from you wanting to understand the material. And so I want you to understand material. I want you to feel confident that you understand what's being talked about. And honestly, you guys, FX Street, out of all the places where I host webinars so far, has had some of the best questions possible. I think that's because FX Street breeds some of the best traders. And you guys are very well educated. You've gotten a lot of experience from a lot of different traders. So your questions are awesome. Some of them actually even help me as well. And so with all that being said, I highly encourage your questions. Your questions are fantastic. And so with that said, feel free to ask questions at any point in time if something comes up for you on the radar and you're having a hard time digesting it or would like more clarification. So I encourage a highly interactive webinar here. So with that being said, and without any further ado, I'd like to begin here. So, all right, the first part I want to talk about, and I really want to go back in time. I actually taught the basics of this class a while ago, and I want to go over this a little more thoroughly. I want to talk about 4 key components for reading price action. When I talk about reading price action, I'm talking on a pure, just price action basis, candlesticks and everything, and I want to talk about why. The bottom line is that unless you have a very, very large account, I mean very, very large account, you're not going to get access to order flow in the currency markets. If you have a level 2 account in the stock markets, equity markets, or futures, you can get access to order flow or a good portion of it. But in currencies, we don't get that, mostly because of the decentralized market there. So because of that, because we're not seeing order flow and we're not seeing volume, we have to look to the next closest clues there to actually determine or get as much information about order flow and volume as possible. Why? Because you and I do not move the market. We do not move the markets at all whatsoever, and because of that, unless you got 50 to 100 million, you're not going to be moving the market. Even then, you're going to have a hard time moving the market, and your only chances are during the Asian session when it transitions from New York to Asia, basically. That's about your only shot at really moving the market, or when the Japanese traders go on lunch break. And they put the B and C trading crews on the desk there. That's about the only time, with that kind of money that you're actually going to move the market. So that being said, we have to trade according to how the big players trade. That's the bottom line. Bottom line is you have to learn how to trade in the same way that the big players do. And with that being the case, since we don't have access to order flow and volume, we have to look to the closest relative to that, and that is price action. Price action has the fingerprints, it has the clues, it has, we are detectives here. If you're reading charts, you are a detective, and you're doing analysis or analysis, as my one friend refers to all the time. So the bottom line is that you have to look to the next closest relative in the nuclear family to give us as much information about order flow and volume as much as possible. And the only way we can really do that is to look at price action, aka the candlesticks here. So my preferred method is candlesticks. Yeah, exactly. Analysis, yeah, as my friend actually refers to it. So technical analysis. So anyways, they're from Paraguay, so they don't exactly translate things well to sometimes in America. It's kind of entertaining. So 4 key components that I am always looking for when I am reading price action, and this is absolutely essential. If you can master these, you'll be putting yourself in a situation where you can kind of detect the environment without fail, without any indicators. I can tell you what kind of environment without any indicators whatsoever. I can tell you if we're in one of the four modes: trending, consolidation leading to breakout, corrective, or range-bound market. Those are the only general four markets or environments that you're ever in. You could technically break them down to two, which is trending and range-bound. Consolidation is a form of range-bound, but it's generally not as wide. Continuation patterns or corrective moves are also generally range-bound to some degree. They're usually some sort of channel that they're in. And so that being the case, you could break it down to two major categories, but ultimately it comes down to the four. And so with all that being the case there, basically, if you can learn to identify these four key points, which I'm going to talk about, you will have a massive advantage in the market. The reason being is you will have information that is going to cue you into where the order flow is skewed, where the order books are skewed. You're going to have information as to whether there's high volume or low volume. You're going to have information as whether there's accelerated selling and buying or deceleration of that. Or if there is neither, if there's no real bias in the market, if there's indecision. We want to know these things. You have to excuse me, I got my little choke on here. So with all that being said, we need to know these things. These are absolutely essential to our trading. And so let's talk about the four principles in terms of analyzing price action. The first, and by far what I would consider to be the most important whatsoever, is being able to identify impulsive versus corrective moves. This is absolutely essential, and it leads to all other kinds of information, but impulsive versus corrective moves. Now, there are many theories or methods out there to analyze price action, many of them out there. However, I think all of them kind of fall short in some sort of way, because what they're doing is they're missing kind of the overall point. They initially hook on to the intelligence and wisdom of looking at price action, but then they abandon ship and get veered off course. So impulsive versus corrective moves was originally created out of Elliott wave analysis, or Elliott wave theory. They were looking at impulsive versus corrective moves to really look at the overall nature of waves for them. Now here's the brilliance of it. The brilliance of it is that by identifying impulsive versus corrective moves, they're able to identify where the market is heavily involved and then where the market is not heavily involved. This is very, very important. I like to be in situations where not only is the market heavily involved, but they're clearly heavily involved in one direction. The institutional players are clearly aligned in one particular direction. That's my favorite type of environment to be in. I like that because that means there's the least amount of people and the least amount of dollars there trying to push the pair in the opposite direction that I want to go. But when you have situations where there's mixed bias, right here, there's no clear bias whatsoever, those are not exactly my favorite environments to be in. Because if you think about it, in terms of order books, that's not exactly a skew to one side or the other. You know, maybe 55-45. I mean, if I were to count those candles up, they would be relatively even across the board, and there's no real winner in terms of pips gained versus pips lost. So because of that, there's no bias, and that means about half the market wants to take me out. I don't like being in a situation where half the market wants to take me out. Bottom line is that when you put your trade into the market, you have now entered an arena. You've entered an arena very much like a schoolyard brawl. The only difference is where the brawl is involving money and intelligence. I don't know if you've ever been in a schoolyard brawl. I've been in a few when I was a kid. I did grow up in Chicago, so I definitely got to see my fair share of action in my time. But schoolyard brawls are very interesting. The type of schoolyard brawls you want to be in is when it's like 70-30, 80-20, you know, those kind of situations. The worst kind of brawls to be in is 55-45 or vice versa, where you're upside down in the numbers. And don't get me wrong, you are in a brawl. Every single person has one goal when they're making a trade here. Every single person that places a trade has one purpose: to make money. There are some people involved in this brawl that have no intention of actually making money whatsoever. Central banks, multinational corporations, they're just getting in because they have to due to the nature of their business or the way they function, not to make a profit. But that is a small portion of the people, a small portion of the time. A larger portion of the people out there are trying to actually make money. So this is a brawl, yes, as the Riddler states, of an intellectual challenge and financial challenge. And you are in a brawl when you put a trade in the market. And so that being the case, I don't like to be in situations where the schoolyard brawl is evenly mixed. I like to be in a situation where, you know what, our group is overwhelming and I got the big mofos on my side. And so that's how I generally like to do it, because I'm not exactly a big mofo. Sorry, you're seeing the volume adjustment here, backing off there. So I'm not a big mofo, about 5'10". But, you know, that being the case, I want all the big mofos on my side. And so that's how I trade, with the big mofos. And so with that being the case, we want to be able to learn how to identify, and that's where Elliott Wave does a great job. They talked about impulsive versus corrective moves. An impulsive move is generally characterized by having some of the largest candles in the entire set for that time period, whatever time period you're looking at. And so as we look, the candles are about even in size here and even in mix. But here, all of a sudden they start to get larger. Boom, boom, and these right here are some of the largest candles. In fact, this candle right here is the largest candle over the last day and a half. So impulsive moves are generally have several characteristics in them. One of them is that they have some of the largest candles out there. And so that's very important. Number two, they generally are strung together or very close together. There's more, you know, of one color than the other. In this case, there's more red than blue. If I was to look at it from this little time period here, we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 candles for this 24-hour period, 16 or 23-hour period, 16 candles. That means there was basically 8 blue candles and 16. So clearly, for that 24-hour period, the sellers or the bears were in control. And so that's another characteristic of impulsive moves. Another characteristic of impulsive moves is that they're generally faster and more violent and cover more ground in a shorter period of time. Case in point, take a look at it from here to here. We went from 133 to about 128, not including the wick here, 500 pips. This thing was only 100 pips for 24 hours, and from here to here was only 200 pips. So 200 and 300 doesn't equal the 500, and this is 2 days, and this is 1 day. So they're much more violent in nature, aka the term impulsive. Now this is the brilliance of Elliott Wave, that they were able to cue into this and say, hey, I want to be able to identify these moves. But the problem is that I think they get off course. They look for impulsive versus corrective moves to kind of get an idea as to where the market is biased, but then they get all involved in the wave count and the alphabet soup and, you know, everything there in ABCD. And the problem with that, I think, is, this is my observation. I'm not saying Elliott Wave is bad. I actually know some really good Elliott Wave traders that I totally respect. I wouldn't want to trade that way for various reasons, but they're good traders, and Elliott Wave can be useful as a wisdom and a method. It just depends on your style. It's not my style. It's not exactly the kind of threads I like to wear when I'm trading. So with that being the case, they get off course with the subjective methods of counting the waves and everything from there. And so but their original intelligence, and there you go, New York, FYM, FX, or NYC FX. Yeah, 300 pips in 2 days on the wave alone. Yeah, absolutely. You can make a lot of money doing Elliott Wave. But I found that it can be very useful. There are a lot of traders who I know who make a lot of money there. From a risk management perspective, I think it has several flaws, and we'll get into that later, but this class isn't about Elliott Wave. It's about price action. But again, Elliott Wave can be very powerful, and you can do very well with it. I'm definitely not bashing it. I think there's some areas, I think all methods have wisdom, and all of them have kind of a lack thereof wisdom or an ignorance. And I think one of the things that Elliott Wave, because you got to remember, no methodology has a monopoly on the truth. None of them do. So, you know, and so that being the case, that means they're going to miss something. I think where Elliott Wave loses track is that it all of a sudden starts gearing up into these other subjective methods when we were right on target by focusing on price action, because it gave us a ton of information about order flow. So if you can identify impulsive moves, this becomes very, very powerful, because these are the types of moves that you want to be in. Is Elliott Wave subjective? I'd say the answer to that is yes. In fact, all Elliott Wave technicians would probably agree with that. So that being the case, this is a general impulsive move. A corrective move, is one where the candles are generally even in color. In other words, you have about the same red or blue, whatever color candles you have. The candles are generally about the same in size. You tend to see a lot more wicks in this situation. And the wicks are generally indicative of two-way interest at various price levels. And then on top of it, there's no clear winner in terms of the amount of pips gained versus pips lost. It's really an even battle there. The best situation you're going to see like this in terms of order books is about a 60-40. And even then, it's not necessarily overwhelmingly convincing. Again, I don't want to, remember, when I'm on the brawl, I want 70-30 or above. I generally don't do that. Now, Adil has a question here. How can one predict such drastic movement before candles are formed? That's an excellent question. We're going to get into that through several methods, but just using impulsive versus corrective moves alone, they generally cue you into it ahead of time. And then let me talk to you about, now this is where I want to talk about sequencing. Impulsive moves are generally followed by corrective moves, and corrective moves are generally followed by impulsive moves. Now, there's also a general pattern. So about 80% of the time, an impulsive move is followed by a corrective move. It's like 80-85. Every now and then, you're going to get an impulsive move followed by an impulsive move, some sort of V-bottom or something like that on intraday or daily time frames. But that doesn't happen too often. About 15 times out of 100, you're going to see those types of moves. For the most part, impulsive moves are followed by corrective moves. So that gives you some information right there as to how you can predict such drastic movements. If that's the case, corrective moves are generally followed by impulsive moves 85-90% of the time. Sometimes you can get a corrective move, and then you can get another corrective move to follow. A different leg, maybe moving subtly up, but it's still corrective and not impulsive. Again, that happens about 15 to 10% of the time. So just looking at how to determine impulsive versus corrective moves gives us information as to when these moves are likely to occur. In fact, right here, we kind of have a mini impulsive corrective followed by another impulsive move. When I say corrective, Bukojo. When I say corrective, I don't know why that name Bukojo looks familiar. Not necessarily your nickname there, but it reminds me of a movie called Gojo's in a Japanese movie. Anyways, when I say corrective, don't I mean retracement? Not necessarily. Corrective does not have to be a retracement. And so it doesn't have to be. For example, right here, this is not really a retracement from here to here. This is just pure corrective in nature. We haven't even made it to a retracement level. You know, maybe we had one little blip to the, to 28.6, but overall, I really wouldn't consider that a retracement whatsoever. So there's a difference. Retracements generally have an angle to them. This one's more flat and consolidated. And Abel's saying, well, what about the now, ergo in the stock markets or euro where it is just a one-way direction? Well, for the most part, on an intraday level, you're seeing series of impulsive corrective moves, impulsive corrective moves. On a larger time frame, you're seeing a relatively impulsive move. However, even on the larger time frames, we're seeing corrective moves. Impulsive, corrective, impulsive. Here, even mix of candles, clearly all red. 1, 2, 3, 4, 5, 6. You know, if you pretty much sold on the open of every candle for the last 7 days, you made money. Same thing here. You're seeing the same thing here. Impulsive, corrective. Impulsive, corrective. Yeah, it is one way, but it's still composed of a series of moves they're able. And so very rarely do you just see straight impulsive. One freak example was the dollar CAD when it just kept trending down from 160 down to like 97, even 95 and 93. Even then, you still saw some corrective legs inside there. But for a large portion of the time, it was impulsive. If I was looking on a weekly chart, ultimately more impulsive. It's hard to count 5 waves in Elliott wave. Yeah, I don't even count 5 waves. I don't count any waves in Elliott wave. I'm not interested in waves. I feel like I can do fine without them, and I do quite well without them. Not to bash Elliott waves. I think they have their own value and merit. Again, New York C, NYC FX trading 300 pips in 2 days. You know, that deserves congratulations there. It just shows that you can't make money. But again, no system has a monopoly on the truth. And that's why I think you have to really look at all the contingent factors there. Okay, so again, we're seeing the series of impulsive, corrective, impulsive. This is a retracement here for sure, but again, impulsive, corrective, impulsive. So just being able to identify impulsive versus corrective alone can give you information about where the next leg is going to be and where it's most likely going to be. And most likely, there's another statistics out there, about 75% of the time, an impulsive move that's followed by a corrective move is generally followed by another impulsive move in the same direction, about 75% of the time. Worst case scenario, 70%. So now you have a method to answer your original question, Adil, about how can you predict such drastic movement. Now, there are other ways that we can actually measure the actual pace and speed and drasticness of the movement before it's formed. And we're going to talk about some of those throughout this class here today. So this is the first principle in terms of reading price action that I am looking at, which is impulsive versus corrective moves. Now, the next one I like to talk about is pips gain versus pips lost. Pips gain versus pips lost is really a subset of the impulsive versus corrective move. Now, to me, pips gain versus pips loss is very, very powerful. And let me go back to, let me slap on another chart here. This is a great example from a hedge fund that I had used a long time ago. So I used to trade for the J&F fund, California-based fund. I was the first and only trader in the history of the J&F fund to actually be hired outside of the actual fund. Normally, they brought people in internally, trained them, as a lot of hedge funds do. They'll train them according to their own methods. This way, they can get a good feel for them. Chris didn't get the hedge fund move. I'm not sure what you mean by that, but I'll go with that. So, anyways, so yeah, they normally train you so they can see you, see how you work over time, and then they can bring you on board. They didn't do that with me. They brought me in and allowed me to trade capital right off the way. So it's very rare that you see that. NYC has a question. It can be difficult when we see reoccurring price patterns. It gets relatively easy to figure out when where in the wave current you are. I use 5-minute, 15 accounts to trade impulsive moves and intraday look at the same as they do no longer on 10. Great, thank you for sharing that. I appreciate that. Again, though, I don't want to get off track here. This is not a class about Elliott waves. It's a class about price action. So let's see if we can stay focused on that there. But I appreciate you giving this information. It's very, very, graceful of you. So thank you for sharing that. Okay, so anyways, we had this interesting sell-off on the Kiwi yen here. The way we did our little calls at the hedge fund is once a week, come Monday morning, we'd all get on a call, president, CEO, and the 7 or 9 traders that we had, and we'd all talk about what trades we're looking at for the week. Now, we were a hedge fund that mostly traded according to swing trading off the daily charts. And so we had this interesting little scenario here where the Kiwi yen had been declining from 87. It bottomed at about 67.71. And on this day, which, if I'm correct, is June 9th, not June 9th, sorry, I don't know why I'm over here. Here's where I should be on this day. There we go. This should be June 9th. And it is. My first trader call. And so we can keep questions for the presentation, just the comments. And that's fine. And I appreciate you sharing comments though. So anyways, on a trader call, and I see this massive downtrend in the Kiwi yen. And they go, Chris, what's your trades for this week? And I say, well, I'm looking at Kiwi yen. President immediately jumps out and he says, oh, great, you're looking at buying Kiwi yen. I said, no, I'm actually looking at selling Kiwi yen. So this was interesting. The first trader call I was on, the guy who was hired outside in his first call is actually disagreeing with the president and the CEO of the company. Very bold move. And he said, why are you doing that? And I said, well, several reasons. And he goes, because we're looking actually to start adding into buy positions here, and we're seeing an inverse head and shoulders patterns. And I said, oh, that's interesting. You're talking about this one here. And they said, yeah, very good head and shoulders pattern, very clear. Good space, even spaces between the left and right shoulder. The head is nicely spaced out. And I said, well, first of all, let's talk about this. From a head and shoulders perspective, head and shoulders traditionally, when you have them, the left shoulder is generally the second lowest low in the entire sequence of the move. And then the head is the final low. In this case, you don't have that. You actually have, this is the second lowest low, and this is a swing low inside that, but it's a higher low. And then on top of it, right here, you're seeing this is the lowest low. So I said from a head and shoulder standpoint, it doesn't stand up. Second of all, if we look at it, just from here, we've declined from 87 to 67, 2,000 pips. Current price, 72 and a quarter, I believe. There we go. So 72 and a quarter. We're 500 off the low, and we're 1,500 off the high. So to me, that tells me just from a pips gained versus pips lost method, that clearly the market has sold off more than it's bought up. I said, let's talk about it from a year perspective on, from 2006 on. Started at 80 and a half, had a 150 point gain basically, and then from there sold off 1,500 pips, and we're up 500 from the low. So from here to here, we're down 800. We had a 150 point gain, and we had a 1,500 point drop. So from a pips gain to pips loss perspective, again, the market is more biased. If you think about it in terms of order flow, the market is more biased in terms of selling off than it is in terms of buying up. So this is where I really look at pips gained versus pips lost over a certain amount of time frame, because I want to see where has the money been made? Where are the order books lining up? If you were buying and selling, were you making more money buying or selling? Who is making more money? Because I really want to know who is making more money on a day-to-day basis in this case. One of the things about dollar CAD is there was a time like it was getting to like 112 and 107 and 105, and every single analyst was saying, okay, it's way oversold, we're deep in oversold territory, blah, blah, blah. This thing's due for reversal. And I said, you know, it doesn't matter. Anybody that's thinking buy right now is completely nuts. Because the bottom line is the money has been made selling instead of buying. A couple weeks ago, I talked about a friend who on the Dow lost $250,000 in a day. I still want to strangle the guy, but that's okay. So he's a good friend of mine. He'll always be a friend of mine. But I want to smack him upside the head for making such a bonehead trading mistake. He was buying the Dow while it's been selling off 4,000 points in the short. You know, what took it 10 years to gain, it lost in 1 year. You trade where the money is. So if the money is being made selling it, then and you're going to be holding it for a fair amount of time, you need to be trading where the money is. Adel's saying, how did I draw the horizontal line? I was drawing it based on here. This is where the year opened. This vertical line is the beginning of the year. Here was the high. Here was the low. And here's where we were come the day of the trading call. So there is nothing super fancy behind it. It was just, you know, marking the highs and the lows and kind of looking at everything there. So anyways, getting back to the story. So on my trader call, I said, look, from a pips gain versus pips loss, you've made more money selling than you have buying. I said, but here's the last interesting fact. So principle number 2 is measuring pips gain versus pips lost. That will really tell you where the money is being made, especially if it's heavily skewed to one side. Now, the last point I want to make here, or the third principle I want to talk about here, is counting candles. And so when you count candles, this can kind of be a pain in the ass, but can reveal a ton of information. It's 72.27. Yeah, it's no rocket science. I just drew it right here. This was the day of the call. There we go. I just drew it at the top of the wick. So yeah. In terms of the actual candles, I counted them. I wish I had TradeStation back then because it could have done it for me with the right programming. But I went and actually counted the candles. Astonishingly, I found something very interesting about this. There was about 54 red candles and 52 blue candles. That to me is fascinating. It's fascinating because the pair had lost from the open of the year to there 800 pips. So what does that tell you in terms of order flow? Well, it tells you that on any given day, you had a 50-50 chance of making money. If you had bought or sold at the open of the candle, if you had just bought at the open of every single candle, you had a 50% chance of making money. Pretty much across the board. It was like 49 3/4. If you had two accounts side by side, though, you had one account that was just buying at the open of every candle, and then you had one account that was just selling at the open of every candle, you would have made a lot more money selling than you would have buying. So the counting candles was and then in relationship to pips gain versus pips loss, was able to give me a ton of information about where the market was biased in terms of order flow. So when I came across with the pips gain versus pips lost, and then talked about counting candles there in relationship to it is and where the market is there, I said, you know what? I'm not interested in buying at this point. I want to be selling. And so here I did. I sold on the open of the next candle. So the open next candle was right about there. And look what happened to it right after that. And the last comment my president said, okay, this is interesting. We'll see where it goes. Well, this is where it went. Sold off 4 days in a row, sold off, finally bottomed a whopping 340 pips later. So if they had bought there, they would have had to weather not only 340 pips worth of losses, which we just didn't do at the hedge fund there, but then on top of it, they would have had to weather that for 3.5 weeks. I don't know too many people that are really interested in, getting in a place where they have to weather 340 pips and 3 weeks of losses with only like 4 up days and the rest all down days. That means you got in at the wrong place. And also following the head and shoulders pattern, the right shoulder should also be the second major low on this side here, not this one. And that's how the head and shoulders pattern ended up playing itself out. My timing was actually very good on that one because I got in right at the neckline. And so with that being the case, the pips gain versus pips loss revealed a ton of information to me about price action and order flow. And then the counting candles was a very powerful method to give me an overall perspective as to who was making money and who was not. Now you could have said, yeah, it's obvious just by looking at that. And that's true, it is obvious. But you didn't get the quantitative aspects behind it as to how much you were actually making in relationship to not. All you would do is just kind of like, okay, it's kind of semi-red, semi-blue. But the 52 to 54 and the 800 pips gain versus lost puts it in a totally different perspective. And remember, this is kind of a numbers game. There's a quantitative aspect to trading. That becomes very, very powerful when you start managing large amounts of capital. I manage a fair amount of capital, and believe me, the quantitative aspects many times influences my trading and saves my butt. And so it's a very important part to be able to do some of the quantitative aspects of trading. Okay, the last part I want to talk about here is time variables. I want to talk about it in terms of patterns, and I want to talk about it in terms of intraday trading. So in terms of patterns, head and shoulders patterns, my favorite patterns, and about the only pattern I will trade, is head and shoulders patterns tend to have a rhythm or kind of a balanced synchronicity to them in terms of how it creates itself. What do I mean by that? Well, when the left shoulder takes a certain amount of time, the right shoulder generally takes a certain amount of time, about the same amount of time. This is about 2.5 weeks, and again, 2.5 weeks here as well. It's very, very common for patterns to have a synchronicity in them. And so it's very important that you can learn how to measure the time variables in it. Same thing here, the left shoulder, 316 to 420, about a month, add on 4 days. And the right shoulder, if we look at it here, this is where the right shoulder lands. And here's where it breaks. You need to go back just a bit. The right shoulder took about the same amount of time there. 6-9 to 7-12, 1 month and 3 days. So very, very powerful. You will commonly see these types of time variables and consistencies play themselves out in the markets. On an intraday time frame, and remember, that can become very predictable for you. When you're talking about analyzing price action, I'm just looking at the time variables involved in the patterns to give me information about when I want to be getting in and when I want to be getting out. I'll go into an example of how that would have been very helpful in the pound yen when it broke down, activating that massive head and shoulders pattern. Now, we'll talk about this for brief. Consolidations also have a certain time component to them. What do I mean by that time component? Well, the longer the consolidation, the stronger the reaction or breakout that is created from it. Think about it this way. You ever heard of something called cabin fever? Many of you have heard it. Think about being boxed up in a room by yourself. A little one-bedroom, not even bedroom, studio room. Let's take it even further. A Manhattan, downtown Manhattan, lower Manhattan studio apartment. Worth maybe $300,000. Hopefully that puts it in perspective. For any of you who have been in New York and lived there, you kind of get a perspective there. Downtown, lower Manhattan studio apartment. You've been boxed in that for a day, 2 days, 3 days. Yeah, 300 square feet. Exactly. Imagine being boxed in one of those rooms for 3 or 4 days without even being let out, without even having a window to look out. You might go a little batty. You might start you might start activating those toys in the attic, as the expression goes. And so that's the case. Because you're boxed up, a stronger reaction occurs the longer you're boxed up. When you get out, you're totally, just either batty or you're totally excited. Exactly. And because all that energy is being bottled up. The same thing goes for currency markets. Currencies don't like to be locked up in 300 square foot lower Manhattan studio apartments. They like to be involved. They like big, spacious, several bedrooms, several, rooms and everything like that, multiple layers. That's what they like. They like to breathe. Order flow likes to breathe because that means that you have domination in the market. 1,600 is cheap. I was in one that was around that size. It was 1,900, so very interesting. I was only in it for a week, though, and then I moved out to a much bigger place. But, yeah. So, the bottom line is the longer you're bottled up, the stronger the reaction is. The less time you're bottled up, the smaller the reaction is. This is very, very important. So when you're analyzing the price action, you're learning to read this price action by looking at the time variables. This goes back to Adel's question, or Adil's question. How can you actually predict such drastic movements before the candles are formed? Apply the time variables here. Very, very powerful for actually telling us how strong a reaction we should be getting. No indicators whatsoever, just telling us how strong a reaction we should be getting. So that covers the 4 principles around price action that you need to analyze. And so that is the first section right here, and what I'm going to do is take a brief sip. If there are any questions on that, I'll be happy to field them now. Before I end this section, I'll go over the pound-yen example, and then we'll move on to a couple things. This chart actually perfectly segues into what I want to talk about next. Now, Forex Champion has a question here. Does consolidation mean that institutional money is not taking part in the trade? That is an excellent question. Let me take a sip, and I'll answer that. Okay. Oh, that's good. Oh, that's way good. I didn't get much sleep last night. I made a big mistake. At 6 o'clock in the evening, I drank something called pu'er tea. Does anybody know what pu'er tea is? Anybody does? Oh my God, you do. I'm awfully impressed. You must be a tea connoisseur. Pu'er tea is a very powerful, Chinese tea. It's a very red, brownish, earthy flavor. It was actually created by accident. The emperor of China at the time had gone through this village, and he had said, give me some of your finest tea, give me some of your finest tea. He'd always do that. He went to this one village, and they had a drought for years. And so what happened is that nobody had any of their finest tea available. It's just all gone. This one older guy goes inside, and he starts searching in his attic, and he realized that he had left some tea there a long, long time ago. And over that time period, it had fermented. And the Chinese emperor tasted it. After he tasted it, he said, oh my God, this is some of the best tea I ever had. What is this? And they didn't know. And they ended up calling it pu'er tea. The interesting anecdote to the story about that, can I please type the name of it? Sure. If I'm correct in my spelling, Puehr. And that didn't come through. I don't know why. There we go. Pu'er. I think I got that right. Maybe it's RH. Somebody in there that's Chinese may correct it, but it's pu'er. It's probably RH, but oh well. That is right. Dang! I get bonus points for that one. My Chinese spelling is good. That's where they got Drunken Monkey style and Kung Fu. Yeah. So anyways, and I'll get to your question there in just a second, Fat. So, but anyways, the last part of that story is the Chinese emperor ended up killing the person who gave him the tea because he wondered why had he held it so long from him since he'd been passing through the village every single time for a year now, and he killed him for holding it and reserving this tea for him. And then he ended up taking all of it and then farming that and using that for his own tea. It's kind of an interesting little story there. Anyways, moving on. So pu'er tea, it's very good for digestion. If you've eaten some bad food, it's excellent for chewing through that, bad food or whatever. But the thing about it is it's also very potent. And so I drank it at 6 o'clock, which is a no-no if you want to go to bed by 10 o'clock. And it kept me up all night. I think I slept about 2.5, 3 hours. Luckily, when I sleep good, but still. So didn't get much sleep. So anyways, I'm drinking something else right now instead of the pu'er tea. All right. So there was a question here, and then I want to go into the pound yen example, and then I'll move into the next section there. Great story, though. What will you have, fantastic question you asked me privately, let's bring it out. What will you have to see now to take the trade on current consolidation? I think what you're saying is, what would I have to see, like what would have to come about for me to actually make some sort of trade on the current consolidation? All right, let's analyze that. Let's do some live price action analysis here. Okay, so first of all, I would probably want to look at some indicators here at this point. But without indicators, I would need some sort of breach of this consolidation here, because the bottom line is, here's your high, here's your low for the last 24, 36 hours. So we're clearly in some sort of consolidation here. And getting back to the original question, there was a question here about the institutional traders there, I think. It said, does this mean that the institutional money is not taking part in the trade? They are, but not as much. The answer to the question is they're not as involved here. There's kind of a combination of indecision in the market right now. Clearly, that's how I'd analyze this. You have no clear winners between the bears and the bulls. However, for a long time, the bears have been dominating. So one would kind of believe that the most likely next move is to the downside. However, if I start seeing 1-2 hour candles close above this price here, then that would tell me that at least a retracement is in effect, not a correction, not a consolidation or correction, but a retracement is in effect. The nature of that move upward would actually determine or tell me how powerful the retracement is. If it's got some impulsiveness to it and the candles are larger than usual and it stays above it, that tells me there's some force to it. Right now, there isn't much force behind anything. It's almost like people are kind of sitting there going, okay, what's the next move? Almost like two cars moving at each other, playing chicken, deciding who's going to turn first. I will notice, though, I will comment that we do have 3 powerful wicks to the downside, 4. So this 27.26 is obviously a level that's being somewhat defended. And my analysis of this as well, look at the size of the wicks here. Let's bring up the little display data box. Okay, right here, the low was 27.36. The close was at 28.06. 70 pip bounce. After how big a sell-off? Well, we sold off from 33.48 to 600 pips. We had a 70 pip bounce. It's not bad. It's a 10% bounce. You should be able to see the pointer now. I hope so. Is anybody not seeing it? Let me know. Now here the bounce is not quite as convincing, but we didn't sell off as much. We sold off from 29.42 down to 27.26. We sold off 200 pips. Here the display data box says the low is 27.26 and the close 27.72. So about a 50 pip bounce. So we had a 50 pip bounce on a 220 pip range. Now we've had about 25% bounce of the actual price action. Very interesting. Same thing here. Now let's take a look at this one here. We're still in that same 220 pip range. The low is 27.34. The close is 28.28. So now we've had a 90 pip bounce. That becomes a little bit more convincing to me. So now you've had about an 80% bounce. This is kind of interesting. So at this point, just analyzing pure price action, this area is clearly well defended. And Boyke is saying, yeah, log in and refresh here. How would I measure the retracement, Abel? Well, I look at where the last leg of the move was, impulsive corrective. So I measure from here down to here, and then I start looking for retracements from there. CPIP saying, when do you assume that a trend is weakening or finishing? That is an excellent question. I will be addressing that a little bit later. I'll actually be addressing that in part 2. But to give you some answers to that, how do I know when a trend is weakening? If we're talking about an intraday time frame, I would pull up senior exponential moving average. And I pull up a 20. Let me get a blue in here. Let's get medium thickness. So I pull that up. Because during a strong trading environment, the market tends to spend most of its time below the 20 EMA. Here now, look at this. Look at this time period. From the 20th on, after the 5th hour, we've been below it this whole time. 3 whole days. Boom, boom, boom. This is the first candle. We might close actually above it. On top of it, looking at this right here, the 20 EMA may be turning up, which could be interesting. It starts making lower highs or higher lows and higher highs. That would be some indication that the trend is weakening to some degree. But just looking at the price action alone, if I started kind of foraying up to here and breaking beyond this, that would be some sign that the trend is weakening, because we've had impulsive corrective followed by impulsive corrective, and we didn't follow it up with another impulsive move to the downside. We followed up with the corrective move, with the bulls taking some sort of mild control there. So that would be a sign of weakening. And the answer to your question, Abel, is the moving average is a 20 EMA, my favorite EMA out there. So hopefully that answers your question there. Also, you can kind of see it by how much time, again, going back to time variables, how much time it's actually consolidating. So here it didn't consolidate that much. Here it's consolidating a lot. That means for a whole 36 hours, nobody's won this little brawl here. We're still at a standstill. So the outcome has yet to be determined. So again, applying time variables. Now, Jack's saying we often see small body candles, then a big long body candle move price down 100 pips, then another up long candle, up same unders. Then how can we find out what is order skew or next direction of the price move? Well, that's a semi-hypothetical question you're asking there. It's hypothetical in the sense that it's not happening right now. So because you can't just look at those two candles and then say, I can give you an analysis of where I think it's going to go. You have to look at the whole picture. You have to look at the whole gestalt. And so to really analyze that, I need more information there based on that there. If you have a real situation, then I can analyze it. It's also semi-non-hypothetical because that does happen a lot. So let me give you some sort of answer here. You often see small body candles, Jack says, then a big long body candle, move price down 100 pips, then another up long candle, same up 100 pips. How can we find out what is the order skew or the next direction of the price move? Well, I would look towards the closes of the candle. That can become very, very powerful. I look towards where is it closing, which candles are closing towards the high or low. That can be very, very powerful. That will tell me where there is no profit taking. Again, if you're closing towards the lows, there's no profit taking really happening. That means the order flow is staying involved in that particular candle into the next one. So that becomes very, very powerful information there. I'd want to see the nature of the wicks too. How big the wicks are. Are they consistently at one particular level like they are here? So I'd really need some sort of live example to give you more information because there's just too much information involved to really give you some information on that. But I would be looking at, the wicks, the closes. I'd be looking at where the previous impulsive versus corrective moves are. And if you want to talk about repeating wick info, go to Jack's question. But right here, if you're talking about this right here, well, from this move, we only had about a 10% rejection right here. But here we had a 40% rejection of this entire range. And here we had about a 80% rejection of this entire range. So very, very powerful information, or 50% rejection. So the type of rejection in relationship to the previous range of them, it gives me very powerful information. So hopefully that answers your question. So Jack, hopefully that gives you some information. I would need some sort of live chart to really do that. You'd basically be saying, hey, do you think this woman's beautiful? She has, this type of nose. She has this color hair. She does her hair like this. And she's this tall. I couldn't tell you whether she was beautiful or not until I actually saw her. So hopefully that gives you some information. And then I'm going to cover one last point, and then I want to finish the 4 principles, and we'll move on here. Otto's saying, can we discuss pound dollar as well? We can discuss pound dollar, but I'd like to get through some of the material before we start looking at, hey, this is where I think the market's going to go next. In regards to the rejection thing, what I'm talking about here is, take a look at the fact that we have 3 large candles clearly rejecting all about the same level. That's a rejection. Okay? 3 of them consistently. The market attacked it, and then it got rejected because it didn't close down here. Some order flow came in to bounce it here. So this candle got bounced. Now, so it got rejected. This level got rejected. It tried to attack it, and then it got rejected here. Oh, you got it. Great, thanks. Okay, so cool. All right, so let's move on. Now, I want to move on to the chart behind it real quick. I want to talk about the pound yen, and then we'll move on to the next section, which is talking about the momentum box and ATR. All right. I don't know why that chart looks so weird, but it does. Here we have a little massive head and shoulders pattern. Every chart technician was watching this in 07, waiting for this thing to break. Now, talking about time variables could have been very useful in telling you when this pair was going to break. Here's the first part of the left shoulder. Here's the second part of the left shoulder. Now, the time in between them, 10:20 to 3:05, it's about 5 months. Actually, it's 4 months and 3 weeks. Now, the right shoulder started to form, and then it created an attack again on that same neckline. Now, looking at the time variables involved, take a look at this. 8/16 to 11/23, 3 months and 1 week. Here was 4 months and 3 weeks. So we got about a whopping 1 month and 2 weeks difference here. A lot of people were looking at it and saying, you know what, this thing's going to break right here. And I kept thinking to myself, you know what, the time variables don't match up. I think it's got a few more weeks to go before we actually break. And let's take a look at what happens. 8/16 to 102, what do you know? 4 months, 2 weeks. So learning how to read these variables and principles in terms of price action can be a huge advantage in giving you information about when things are going to happen and when the powerful moves are going to happen. All right, so with that being said, I want to move into the second actual portion of this webinar here. We're still within the first part about talking of the price action, how to analyze price action, but I want to move into something different. I want to talk about the momentum box and ATR, how we can use momentum and how we can use ATR to give us information about reading price action. This is where we start to bring in the indicators then. So let's pull up momentum and let's pull up ATR. Now generally when I trade, I like to have 4 types of indicators out there, minimally 3. I like to have a momentum type indicator out there. I like to have a trend type indicator out there. These are all different categories. I like to have a volume or volatility indicator out there. And I like to have some sort of oscillator that can kind of inform me about swing changes. And so momentum, in terms of needing a category, momentum is probably my favorite indicator within the momentum categories. It's very close. It's a leading indicator by classification. And it's one of the few indicators out there that's very close to volume in some aspects. It's very good at gauging volume because momentum only gets influenced by volume directly. ATR is another one that gets influenced by volume directly. But ATR really doesn't gauge the internal momentum. It's a volume/volatility indicator by nature. Whereas momentum gets influenced by volume, and it can only get pushed heavily by volume or severe lack thereof. But it gives me cues about order flow. So if we're trying to get information about order flow, I like having momentum up there because it's giving me some of the best clues I can possibly get as to where that order flow is. Is it consistent with the direction it's moving? Is it forceful or is it not forceful? And so to me, momentum is probably one of the closest indicators you will get to actually seeing some sort of measurement of volume. If we were to actually have volume here, it would probably be very consistent with the momentum indicator as a whole. Very powerful stuff. Okay, so now one of the things that happens in trends, as it's happened recently in here, and we'll talk about divergence as well, is something called the momentum box, something I call the momentum box. Now, let's zoom back just a little bit. We did have kind of a bounce off this little low here, 32.5, went all the way up to about 38. sold off back to about 33.5, and then we went into this interesting consolidation period. But from here to here, we dropped about 500 pips. Then we went into this interesting little period here where we saw, let me zoom out just one more time there. Great. Where we saw this consolidation happening within the euro dollar. It lasted for about 56 hours. If you were to count this part, about 72 hours. So quite a long period of time that we went into this consolidation here. We were stuck between 35.38 and 33.48. So 190 pip range there. Now, what is also interesting about it is that momentum also got into a box as well, or consolidation. This is what I call the momentum box. When I see price action getting stuck between a floor and a ceiling, hemmed in, and it's holding it for a fair amount of time, then what I look to do is I also start checking out momentum. If momentum is exhibiting a similar behavior, then I draw the highs and the lows, and I watch for a break of the box. You're saying you grabbed 300 pips in there. Congratulations. Well done on that. And so, again, though, comments, try and keep those in. Questions, I try and keep this about questions, not about comments. So when I see these consolidations, I will look to momentum and ATR to determine when I want to get in the trade and if there's a breakout happening. Now look what happens. Again, 72 hours consolidation. Same thing with momentum. We get stuck in this little box. We make no new highs or lows. Now, I have a general method for determining whether the actual breakout is healthy or not. And this is based on momentum and kind of based on similar volume analysis. These techniques work well if you're trading stocks or futures and you're measuring volume analysis, these same percentages, and we're going to talk about it. Once price action breaks out of the actual consolidation period, oftentimes momentum will as well. We had a little bit of a blip here, but it actually didn't break out of it or close out of it until this candle. However, take a look at momentum. Momentum had already, the candle before, broken out of its box. This becomes very, very powerful in terms of telling us what's going on with the price action, because it's saying, you know what, for a while, the momentum had neither been gained nor lost. In other words, the volume levels to push the momentum in one direction or another were not convincing. Now, for the first time in 72 hours, we're actually getting a momentum reading, which is influenced by volume. We're actually getting a momentum reading, which is telling us the momentum is severely shifting now, or the paradigm shift in momentum is shifting to such a point that we're probably going to break out here. And it did it before the actual pair broke out. Now, what I like to do at this point is actually start marking where we have the breakout. The breakout was on the 8 o'clock hour, 8 o'clock California time. And so what I often do is this. I will look at the relationship of the decrease in momentum from here to here, from the candle before to the candle of the breakout. And then I'll also look at the difference in the relationship of the ATR and the actual candle where it broke out. Why am I doing this? Because I want to quantify how strong or forceful the actual breakout is. By quantifying it, I get a perspective as to how powerful it is. From a momentum standpoint, I'm seeing how much the momentum is changing in difference. But then also from an ATR standpoint, this becomes very powerful because the ATR is also very good at measuring volume and volatility. Volatility can only change, average true range can only change when there's significant changes in volume and volatility. Volume and volatility is directly linked to order flow. It's cueing us into where the market is moving. And so this is very powerful for us because a good enough change in the ATR can tell us, you know what, there's enough force behind the order flow to create this breakout to make it legitimate. So measuring the candle before, let's talk to our little display data box. Hello, Hal. Call it Hal. It's like the HAL 9000 there from 2001 or 2010, A Space Odyssey. Anyways, so Hal here is saying on the candle before, if you look at the box on the bottom, it says ATR. It had a reading of 0.00453. So basically 45.5 pips. Let's just shave it off to 45. So 45 pips was the average true range for an hourly candle before we broke out. Average true range as an average range from high to low within that particular candle. Now let's see the actual change in momentum was 0.01020, so about 102. Now let's take a look at the next candle. The next candle, the momentum goes from 102 to 134, about a 30% increase. That's significant. Or in this case, a decrease. But it's a decrease in momentum by 30%. To me, that's significant. Anything above 15% decrease in momentum is significant. But what's more interesting is the ATR. Here we're at 45.3, and here we're at 48. So we had about a 3 pip difference in the ATR. That is a pretty decent enough increase for me. So 3 pips, you're talking about, let's measure it. Let's go back to the data box here. 45.3, 48.2. So 3 divided by 48, 6.25%. 6.25% is a decent enough increase for me. Once I get above 5%, I'm usually kind of paying attention to, okay, I've had a 5% change in ATR, also an increase. If I had a 5% decrease in ATR, that would tell me there wasn't as much volume or volatility behind the actual move. But the key component is not only was an increase of 6.25%, but the ATR increased. So to have an actual increase in ATR, an expansion of the average true range, there has to be more money coming in the direction of that move than there is going out. So to me, that becomes very, very significant. That tells me that this breakout is legitimate, and then I could probably get on in the open in the next candle. Now look exactly what happens to this actual trade. This is the high and the low. Look what happens. We break out, we retest it to the T. Notice how impulsive corrective move also further supports the price action. Reading this further supports the actual trade itself. The declining 20 EMA, falling resistance, evolving falling resistance tells us this also further supports our trade. So now the question Mike has, but where would I enter then? Well, you'd have a couple options. Option number one would be on the open of the next candle. Option number two would be to hope for a retest of that same price level. This one is a little aggressive. This one's a little more conservative, defensive. Option number three is when you see the increase in the ATR and the momentum support each other, and you have a decent enough increase, 5%, 8%, 10%. When you have that kind of situation, then another method is you could trade the actual break. But that becomes a little bit tricky. I would suggest nothing less than a 15 pip break. I want a 15 pip break of the actual range to actually get in the trade. So those are your three options. The advantage of getting in here is that if the pair just keeps going, you actually catch the move. The disadvantage is that it increases risk because you have to put your stop somewhere inside this range. I wouldn't recommend putting it 50% in the range. If the price action goes halfway back into the range, then that means you really got in at the wrong time. It shouldn't be going 50%. It shouldn't break out by, how much did it break out by? It broke out by a total of initially 60 pips on a 190 pip range. So you're talking about 33% breakout. It shouldn't break out 33% and then retrace 50% back in. It means you just got in playing at the wrong time. So the advantage of this is if it keeps going, you get to be in it. Again, you also increase risk. Most conservative and the least risk is getting in very close, within 5 or 6 pips of the actual previous floor in this case. So that would be the most conservative option. Low risk, you also have market confirmation. Breakout, retest, the market considering for 1, 2, 3, 4, 5, 6, 7, 8 hours, saying confirming for 8 hours, we now treat this as a roll reversal level, aka we used to treat it as support. We are now, through 8 hours of price action, establishing via our own money, two different sets of order flows too, New York and Asian session, saying we no longer consider this support, we consider this resistance. So that would be the most conservative method there. Now, question. So hopefully that answers your question, Mike, in terms of where do we enter. Now, the next question is this. Pip Pimp. Nice. I hope you got a jacket there that also, yeah, I hope you got a pimp jacket. That is awesome. Good name there. So how do you determine how long you'll stay in the trade? That is an excellent question. Well, one of the methods that you can do with that is your 20 EMA. The 20 EMA should keep you, if it's a trending move, should keep the market on that one side of the EMA for the majority of that move. Also, it should keep you in the move for the majority of the time while the order flow is favorable to that particular direction. And so the 20 EMA could be a great way to just stay in it the whole time. In Ichimoku Cloud, if the Ichimoku Cloud, and for those of you who've taken my Ichimoku Cloud classes, that could also tell you how long to stay in the trade. Now, there's another method we could use. And the answer to your question, Pipnik, do you usually use momentum setting at 12? Yes, because there are 6 trading days within a currency week, and so I set it at 12. Momentum was originally designed to measure 2 weeks worth of price action. So some charts set it at 10 because they were doing it based on the equities market. So I set it to 12 because it's based on 6 trading days. 2 weeks, 12. Now, here's the interesting thing about it. Method number 3, or not, besides Ichimoku, besides Bollinger Bands you could use besides the 20 EMA, is we could go back to our momentum box method here. And I'm glad this has actually happened because I was hoping, I was praying last night that it would happen to illustrate my example. How long do you stay in the trade? Well, momentum can give you a cue as to when you want to stay in the trade. How, you say? I'm glad you asked. Well, if momentum was consolidated within here, and this was the floor and the ceiling while it's consolidating here, if momentum is a leading indicator, it should break out before the actual price action does. It does. So now, when would I get out of the trade if I want to use momentum instead of a 20 EMA? Well, I'd want to get out of the trade when the momentum has eclipsed the previous high in this case. Since it was a breakdown to the downside, I'd want to eclipse this high within the box. And so if it was a buy up, then I'd want the momentum to break out to the upside and then break below the previous low. Well, take a look at this here. Let's move on. Look at this right here on this candle right here. Momentum broke above the previous high here, the same candle that it broke above the 20 EMA. Amazing how it does that. And this is amazing how the momentum box method works. Absolutely powerful. So you want to know how long you stay in the trade? Well, you can use the 20 EMA method, which is carefully tracking price action, or you can use the momentum box method and wait for it to breach the far end of the box there. So hopefully that answers your question. I just gave you 2 methods right there. There's also Ichimoku and Bollinger Bands, but I don't want to go into it. That's a whole other class. So hopefully I've answered your question as to how long you stay in the trade. All right. We got about 20 minutes left here. Awesome. Fantastic. So does everybody feel pretty confident about the momentum box? I have one more example I'd like to talk about. Does everybody feel confident about the momentum box method? 20 minutes left. Heard you just said it. Yeah. Cool. Okay, great. Another example would be good. All right, fantastic. We will do that, Sue. So let's talk about dollar Swiss. Okay, let me just make sure I've covered. I've talked about momentum box and ATR. Good. More EMAs. All right, great. Fantastic. All right. Wow. What are the chances of that? That almost never happens there. I just flipped from a euro dollar to dollar Swiss chart, and the lines that I drew that boxed up the momentum are the exact same lines that boxed up the momentum for the dollar Swiss. That almost never happens. Spooky. All right, so anyways, let's talk about the same method here. We enter into a consolidation on the dollar Swiss. Now, the dollar Swiss is a little bit trickier. It's trickier because dollar Swiss tends to be a little more, how could I say? It tends to whip around a little bit more in ranges. And tends to have a little bit more uniqueness with the wicks. Tends to be more exaggerated with the wicks. Zoology is saying, but isn't the Swissy not inversely correlated to the euro? Yes, generally. That actual correlation broke down in 2007 because the dollar Swiss was selling off, and so was the euro dollar. They were all selling off at the same time. There was a correlation breakdown. Anybody who was a Freedom Rocks trader got murdered during that time period because that was based upon the inverse correlation. Anyways, yes, they generally are, but that correlation doesn't always hold. It's just that, a correlation. And as we can see, correlations can often break. All right, yeah, but the thing you're saying about hence the fit, that almost never happens because the momentum readings on the Swissy are generally far different than the dollar, than the euro dollar. Just totally rare. So, anyways, kind of spooky. If you let me enjoy it, that would be appreciated. All right. Jack's saying, does the momentum box often come out when price move in a range? Does the momentum box often come out when price moves in a range? Yes, you also see that. There's another time that the momentum box also comes out. It's actually when you're within trends. For example, something could be trending heavily in one direction, but you can see momentum consolidating. That consolidation of momentum is telling you that the price section is going to continue in that particular direction. It's telling you it's going to be a continuation because there's no change in momentum. The momentum is just kind of carrying it along. It's not forcefully pushing it in one direction. It's not beating it down. It's just matching pace with it. It's what we call lockstep or pace momentum. And so you'll often see the momentum box both in ranges but also in trends. When you start getting towards the latter ends of the trend, you'll see the momentum consolidate within a box. Very powerful method there. So, but let's talk about this example one more time. So dollar Swissy tends to whip a little bit more than the euro dollar does. Now, for this time period, it was stuck within this range. It had one little false breakout, which is kind of pain in the arse. But how did we know it was a false breakout? Well, the momentum box actually cued us into it. Why? Because we didn't get any break in momentum here. If you look back, we have 3 peaks and troughs within the momentum. None of them broke, and look what happened on price action. Breaks out, momentum didn't come close, and look what happened. Stop along with momentum. So no break in momentum, no break in the actual range, not a legitimate breakout. And this is a beautiful example of showing you how well this momentum box works. Now take a look at this one here. Price action breaks out. Go figure, same candle momentum breaks out as well out of the box. So momentum broke out of the box, telling us that it was a legitimate breakout. Boyke says, momentum box is set to your day settings. Your comment is set to other days times. That is another part of the world. I don't quite understand that question. Can you rephrase that for me? And then I'll move on. So yeah, anyways. That being said, momentum box was actually a key for telling you when the breakout was legitimate. It totally protected you here, and it totally got you in here. Very, very powerful method for doing that. Now, let's also take a look at senior ATR. Well, in this candle, Hal is saying at the 6 o'clock hour, we had a momentum of 490, and we had an ATR of 28 pips, about 28 and a half. Okay, now in the next candle, let's see if we have momentum being supported by the ATR. Momentum goes from 490 to 1030. Huge jump in momentum. Huge jump in momentum. That's absolutely astronomical. About 100% increase in momentum there. So that should be a very good sign that this is a very legitimate, healthy breakout. And then what's the difference in the ATR? Well, the ATR was at 28.6. Here it's at 32. Let's do the mathematics. And I see your questions. I'll get to them in just a second. I see you out of my peripheral vision. All right, 28.6, 32. So we're talking about a 4 pip difference roughly. Well, 4 divided by 32, 12.5% difference in the ATR. So to get a 12.5% difference in the ATR, we had to have a significant increase in volume. So again, when you get the breakout on the momentum box, you also want to make sure that ATR is increasing, not decreasing. Very, very important. All right, now, the questions here are coming across the board. Boykie's saying your vertical day lines. Yeah, my vertical day lines actually represent the London Open. So this is midnight California time. Momentum box is not set to the day settings or anything like that. It's just set to 12 periods, basically. And this vertical line is just the London Open. Okay, Adio's saying once the breakout occurs, then we reset the momentum box. No, you leave the box where it is. And so, yes, you leave the box where it is. Now, for those of you that were the conservative traders looking for the retest, you didn't get it here. So here is now the advantage of getting in on the open in the next candle. Very, very powerful. Or you can wait for a 15-pip break. Here you had a 15-pip break, but you did not have it in momentum, therefore it's not a legitimate trade. Here you have the break in momentum out of the box, you have the increase in the ATR, and your 15-pip break would have got you in somewhere right around here. So very powerful. 15 pips is usually enough. If the range is like 300 pips wide, then I would increase the size of the break. But you generally want about an 8% break of the range. Now, Sue's saying, do we draw the box only when ranging? You draw the box when you see it. It more often comes up when it's ranging. However, again, as I talked about, there are certain times during trends that the box will come up, and I would draw it, and then let's say we had an uptrend, and then momentum was boxed up, I would draw the box. As soon as we broke out of the box to the downside, that to me would be a good sign the trend is over. Okay, so now we have a question here. Asha's saying, how do I use Elliott wave then, if you do not count it? I don't use Elliott wave here. I do look at impulsive versus corrective moves, but I don't use Elliott wave whatsoever. And so I'm really only looking at impulsive versus corrective moves here. Very powerful, because that tells me where the order flow is most likely biased. Now, Forex Champion, do you also look at patterns within momentum indicator? Yes, excellent question. That is a gold star question for today. So let's get back to euro dollar. Let's delete some lines here. Do I look for patterns? Yes. There are a few patterns that I often see in momentum. And let's talk about them. Let's see if I can get on a daily time frame here. Do you get a prize? Yes, the prize will probably be rewarded to you in pips through your intelligent trading. That's your prize. Okay, there are a couple patterns that I will look for in momentum. Remember, momentum is like a shadow. One Argentinian peso. Nice. Momentum is like a shadow to price action. It's often ahead of it. More often than not, it should be ahead of it. So because it's very much like price action, I mean, take a look at this here. We have the left bump here and then another bump. Same thing here. We have the same thing in terms of momentum as well. So the same patterns that I look for in momentum and price action, I also will relate to in momentum. Head and shoulders patterns, very, very powerful in momentum. This I would not look as a major head and shoulders pattern because it's not coming after a large up move. Remember, head and shoulders pattern is a reversal pattern. So if I'm getting a head and shoulders pattern in a falling market, then to me it's not a legitimate head and shoulders pattern. It's something different. So that would be the first thing. The second thing is I'll also draw fibs on momentum to determine if we are within one of the three momentum models. You have three general momentum models as a whole. You have ahead of price action, where momentum's ahead of price action. That's the healthiest model for your move. Let's say we're selling and momentum's ahead of it, then that is the healthiest situation you want to be in. You want momentum to be ahead of price action. You have the second model, which is keeping pace or lockstep, and that's where if price action retraces to the 38.2 and momentum retraces to the 38.2, that means they're dead even with each other. And if you're looking to sell it, that means it's good information, but it's not the ultimate. It's not the best situation possible. So that's the second model. The third model is you got momentum behind price action. In my settings, again, on momentum, I don't have settings on the momentum box. I just have settings on the momentum. On the momentum box is really just drawn in relationship to what I'm seeing with the momentum. So if it gets boxed up between a high and a low, well, then I just draw horizontal lines there. Again, I'd like 2 touchdowns at least on one side of the box of momentum. Ideal is 3, but 2 is good enough. If you have double on both sides, even better. So with that being said, that is how I do look for patterns. I pull fibs on it. I draw trend lines. As you can see, I'm drawing horizontal lines. And there's one last pattern I'd like to talk about. And let's see if I can find it. Might have a better chance on an intraday chart. All right, this is pretty close. It's about as close as we're probably going to get. Let me try one more chart. All right, maybe this year yen will do. Let me try one more. I'm teasing you. Oh, here we go. Okay. This might work, but I'm going to start with the pound yen. Okay, there's something that I've noticed over time. There's a pattern I've also noticed within momentum over time. What I would call, excuse me, what I would call the 3 peaks of death. I would call it the 3 peaks of death because I've noticed oftentimes that you will get like a triple peak in momentum, and then after the 3rd peak, a new change in the move happens, somehow, some way. And so let's talk about it here. Here I have 1 peak, 2 peak, 3 peaks. It breaks down, creates a whole new low, and then look what happens. This is where also the price action breaks down from here. This 4th peak, not even close in height to the others, comes from a new low, and look what happens as the result. Boom, massive sell-off. So I've just often noticed that pairs tend to exhibit a triple peak of death. When I see that 3 peaks, I'm often looking for some sort of reversal or swing change or something like that. Very, very common in the market. Not quite seeing it totally here, but very, very common within price action there. So that's the other pattern I look for. But the box, Fibonacci's, retracements, trend line breaks, same thing. Now, there's some questions here. If you see 2 momentum boxes, a big one and a small one, which one to be used? Great question, Jack. That's an excellent question. You want to use the larger one. You want to use the biggest container of all of them. And so, because that's the one that's really holding everything there. Ritter was saying, where can you get this momentum indicator? My definition of momentum is different from MT4. You'd probably have to get it from some other charting package, basically. You might be able to, I don't know if MT4 has another way to do it. One other one you can use is rate of change. Rate of change and momentum are actually almost the exact same indicator, except one's based on a ratio and one's based on a percentage. To illustrate this case in point, let me pull up rate of change. Let me get rid of ATR. And let me show you rate of change. Rate of change I also set to 12. And look at that. Looks exactly the same. So it's just the readings are different. Percentage and ratio. It's the only difference there. So hopefully that answers your question. You can try rate of change. And Boyke is saying triple peaks of. I call it the triple peaks of death. The reason why I call it is because whatever move has been leading up to that triple peak usually ends, dies. And so that being the case, and all moves eventually die. Just like us, birth is an actual death sentence for us. It's a terminal illness. Same thing in the markets. All moves must come to an end. So that's what I call it the triple peak of death, because when I see that, that usually means that the move is coming to an end. Okay, so we got about 5 minutes left. T prolongs life. Nice. So we got about 5 minutes left. I've covered the EMAs and how I use it. I've covered the momentum. And I've covered the momentum box in ATR, how you can look for the readings in them. And I've covered the 4 principles of price action. So that being the case, with this last 3 minutes, I'm going to go over the pound dollar and analyze it in terms of price action. All right. And so let's take a look at this. Pound dollar has been stuck below on the 1 hour chart. Oh, and there was one question on what time frames do I justify, or what time frame charts would I use momentum to justify entry? That momentum box works on any time frame. Any time frame. But my favorite, 1 hour and daily charts. Okay, now, so talking about the pound dollar actually executed a momentum box as well. But let's take a look at it here. Analyzing price action right now, and how would I read it? Well, where are the impulsive moves? Impulsive, corrective. So I would be more biased to the downside than I would to the upside. Being that the series of impulsive moves and corrective moves are in sequential order. Impulsive move to the downside is followed by a corrective move, is followed by another impulsive move to the downside, corrective. So that being the case, I want to look for more sells than buys. Further analyzing the price section, we've been stuck below the 20 EMA and we haven't gotten above it, unlike our Euro friend. We've been stuck below it since the first few hours of October 20th, 3 days ago. So 3 days ago, we've been below the 20 EMA. The order flow is heavily skewed to the sell side. Even with the corrective moves, they've rejected it and gone on from there. So I'm still looking for more buys than sells. If I want to be aggressive, I can sell at the 20 EMA. It's been containing it. However, momentum is starting to make some sort of a case. We're seeing some good divergence in the momentum. So if you are going to be selling it, caution is advised. We also don't have the rejection places that the euro dollar did. We've had one rejection here close to 160, but it's still continuing to make lower highs and lower lows. So with the lower highs and lower lows, and with all that being said, I still favor sells on this completely. Until I see a break above this region right here, and the 20 EMA turning up, and new highs in momentum, aka above these peaks here, I'm really not looking for sell or buys. I'm only looking for sells. So that would be analyzing in terms of price action. I've used all the principles here: impulsive versus correctives, the EMAs, the momentum, pips gain versus pips loss. It's all clearly apparent right here. That's where I want to be. And so we can wrap this up, absolutely. So first of all, I want to thank you all for coming. And by the way, Maud, you said, can we please warp this up? So I think I've already warped it enough. Anyways, so I want to thank you all for coming in such awesome numbers. It was fantastic having you all here. And so this, we're coming to the conclusion of the open webinar. I hope you guys enjoyed this on how to read price action. This is stuff I do every single day. Every single day. And this will become very potent information because you'll be in trades sometimes that won't necessarily work according to your system. And your ability to read price action using all these principles will help you determine in real time whether you want to be in the trade and whether you do not. And so I hope you enjoyed this very much. For those of you who are not going to be at the premium webinar, I'm getting very close to retiring some of my services, aka private mentoring, aka selling my systems publicly, because the income is becoming very significant to the upside, to where White Knight Investments is just going to buy the intellectual rights to it. So for those of you who are interested on what made me become a good trader, my systems are about 80% of the success of that. And so if you're interested in private mentoring and learning how I became the trader that I did and learning these techniques, or if you're interested in learning about the systems that are behind this, well then check out my website, twoindyskies.com, check out the White Knight, and then if you have questions, you want to email me directly, info@twoindyskies.com. So doing the usual going around the horn and thanking everyone that came. Ed's asking, am I CTA certified? Yeah, I passed that test a long time ago. I'm not CTA though. I took a Series 3 license basically. So that's the one for currency traders basically that we had to take and work for the broker. Anybody who worked for the broker had to take it. And I passed that test a long time ago, and thank God, because that was such an annoying test. Pain in the arse to study for. But anyways, I don't know what that has to do with me being a good trader, but I'll go with it. Anyway, so going around the horn and thanking everyone. CBJ, Jenko, Chino, Faruch, Mike, Lily, Fat, Musk, Tom D from California, Ray, Bones, Jeremy, Jack, Ashu, Joe, Mac and A, Fax, Tread, Boyka Midori, Joe the Plumber, nice to see you. Firaxis, Harley, good to see you guys. CompUSA, Buka Joe, nice name for us. Champion Fred, Pip Pip, John Null, Arnie, WinFX, Andrew, Netty Boy, NYC, Elliot Wave Man, Rover, Indy Grab, Leo Stu, Azure Master FFG, Pipnik, Riddler, Joe, Trader Kurt, Richard, Abel Din. Richard DM, you got an interesting login there. You got the headset. Smokey, Expert Shark, Netstar, Stevie, Pip Rider, Javelin Cast, C-Pip, Srini 1, Jiminy, Ed, Ula. Awesome. Good to see you, Ula. Oscar, Soul Beach, Latovich, Dorks, Bobby, Merck, Peter, Sully, and Trade Dyer. Thank you all for coming. It was awesome having you here. If I get to see you at the premium webinar starting in about 15 minutes, I hope so. Until then, I will bid you adieu and good hunting. And if I don't see you, I'll be seeing you tomorrow at another premium webinar. Until then, good hunting, everyone.